A few days ago, I was hanging out with a few friends and we were talking about our stock portfolios. One of them mentioned a company that I've literally never heard of, and I instinctively looked it up. It was about $300 a share. First thing that came out of my mouth, out of habit, being Asian, is that that's a really expensive stock. The problem is that that's how retail investors just instinctively think, right? Because we're used to shopping for shit. When you see something expensive, you say it, right? That's expensive. But if you're a real investor, that concept is really, really wishy-washy. It doesn't really mean anything. How you should look at investments is looking at things that are overvalued or undervalued. You look at gains in percentages. So a $10 stock can be overvalued and undervalued as much as a stock that's $1,000 a share. It can also be overvalued and undervalued. Similarly, if you had $1,000, if a stock is severely overvalued, then regardless of whether you're investing $10 a share or $1,000 for one share, you have the same amount of opportunity to lose your money. It all depends relative to the company, the business vertical, its value proposition, relative to its PE ratio or PS ratio, depending on the stage in which this business is at. In this video, we're going to talk about what PE ratio is. And in the next one, we're going to talk about the PS ratio. We're going to talk about what it is, how you can leverage it, help you figure out if a stock is overvalued or undervalued, and potentially how much gain is there to be had for any particular investment. So if this is the type of content you've been looking for, please hit that like button for me, and let's get started. Okay, so the PE ratio is the current stock price divided by the annuals per share number calculated on a 12-month basis. The earnings per share number is how much profit is generated per share of stock. So let's talk about a real example, right? If we're talking about Apple, their annual EPS is 3.28, and their current stock price, when I looked at this thing, is 121. So their PE ratio, if you divide the two, is around 37. Now, what do you do with that information? What you do is you look at other companies in similar industries and size. So let's say we're looking at blue chip tech companies, right? So maybe you look at Google, maybe look at Microsoft. Google's PE ratio is around 35.8, and Microsoft's PE ratio is around 34.5. Now, hypothetically, if we're only looking at these three companies, then we can say that on average, the investor sentiment in terms of the right PE ratio on average is around 36, maybe 35.5, something around there, right? Let's round up and say 36. What this means is that if a company in this industry is performing well to expectations, let's say, then their PE ratio should be around 36. If it's higher than 36, then the investors are more optimistic about this particular company. They think that it will perform better. And if a company is under that, so Microsoft is around 34.5, that means that people are less optimistic about Microsoft's long-term vision. You can use this information to create hypotheses. So for example, you can say, I know that Microsoft will put out something amazing in terms of remote office productivity for the next 3 months or 6 months. They're going to come out with something really, really awesome to compete against Google, let's say. If that's the case, then it's going to drive the stock price up. And if the stock price goes up, the PE ratio goes up. And you can have an idea that at the very least, it'll probably hit the PE ratio of the average companies in this industry, right? Around 36. So if Microsoft stock is currently 34.5, average is 36, you get an idea that perhaps there's about a 4% gain to be had if you invested in Microsoft, if you're right about your hypothesis. Now, the counterpoint of looking at this is that if you're looking at the Apple's PE ratio and it's at 37, higher than average, then probably a lot of optimisms are built into the stock price already. So unless they put out some interesting earnings or interesting news that is a lot more interesting than normal, then the stock price will probably stay the same. Because again, the optimism is already built into the stock price, right? they have to do better. And if the P ratio is way higher than average, because today, if you look at some frothy stocks, their PE ratios are in like the 200-300s. Then what that means is that if any bad news or average news come out, there's a higher likelihood of them adjusting downward towards the average. And since the stock price is so much higher, that's why the PE ratio is so much higher, there's a bigger, steeper cliff to fall down to that average, right? And that's why I highly recommend that you don't invest in frothy companies for this specific reason. The last thing I want you to keep in mind is that in order for there to be a PE ratio, they have to make positive earnings per share. That's why you don't always see the PE ratio on stock tickers. When that happens, it most likely means two things, right? Either the company is being run like shit, or they're reinvesting all of their money. So much so that they're not making any profit. And there's nothing wrong with that. Amazon actually was famous for doing that. And now look at them, right? So it all depends. It doesn't mean that they're a bad company if they don't have a PE ratio. That's actually when you should leverage the PS ratio if you truly understand and believe in the value proposition of whatever company you're looking at. You look at the PS ratio. And in the next video, we'll talk about what that means and how to use it. So if you found this content useful, please hit that like and subscribe button. If you're new to the 11ish Collective, welcome. If you have any questions or suggestions, please leave a comment. Thanks for watching, and I look forward to working with you next time.